Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So if you are like me and you are stock picker and you're looking for individual stocks all the time and you're looking for quality businesses that are undervalued at the moment, it can be really sometimes very difficult to find these things. And right now, based on what we've seen in the last couple of weeks, especially in the last 3 months more like, it's becoming very difficult because everyone is focusing on this side of the S&P 500. So the S&P 500 hit all-time highs yesterday. That's the highest it's been since 1800 or whatever it was, right? So when you look at this, you're like, okay, everything else is going to the moon, and, you know, there's no opportunities out there. Now, if we look at for the 1 week, again, it's technology companies that are taking the lead, especially the semis, and everything else, it's actually down. If you are interested in some of the semiconductor companies that are undervalued or fairly valued at the moment, watch my last video where I talked about the semiconductor companies. Now, for the 1 month, again, is more or less the same. So we've got a couple of technologies, we've got a couple of healthcare companies, but look at this for the last 3 months. Check this out. Almost everything is green apart from a couple of pharmaceutical companies or pharma companies or healthcare and the energy sector, as well as, of course, a Tesla. Everything else, Nvidia is up 40%. Broadcom is up 36%. Microsoft 20%. Okay, 70% for AMD. Even Intel is up 35%. So there's so many companies that have done absolutely amazing in the last 3 months. And when you see this, you sometimes think, okay, there's no opportunities out there. But I'm going to show you today an opportunity that I've come across the last couple of days. So I'm going to share that with you guys. But before I do that, as always, if you like the, can you just press that like button? It really helps the channel. Of course, you can also join us on the Discord, where you get access to basic access to the Discord, as well as, of course, getting access to the Patreon account, where you've got access to a million different little things. Over exaggerating, it's not a million, but you've got buys and sales, you get the dividend trackers, you've got dividend stock, the watch list if you like, and then of course you've got the Sharia compliant invest in ebook, as well as the Discord access. So you've got all of that, inshallah, if you want to join us there. Now, the company I'm going to talk about today is called Cummins. Cummins is one of those companies not many people really know about. So let me just give you a little bit of information about the company. So they have 4 different sectors in terms of their business. They've got the engines, they've got generators and power systems. They've got the accelerator, which I will show you exactly what it's about now. This is more to do with newer and upcoming technologies kind of thing, and components. So what they do is they create their own engines with their logo on it, and they work with other companies like the Fords and the GMCs and all of that, to actually produce their engines for them. So engines that have their name on it, as well as, of course, they're creating their own engines. So that's how the company started, but they're trying to diversify now into getting more or less to renewable energy kind of things. And one of the things they're working now is the accelerator, which is basically a newer technology that they basically trialing out, and I think it's about 1% overall of their entire portfolio of things that they're doing right now. So the breakdown is this: you got the components systems, which is about segment, which is 33%, distribution segment, which is 24%. You got power systems, 14%, and then you've got engine, which is 28%, and that accelerator segment is only 1%. But their plan is to create, basically to grow that, inshallah, in the next whatever years. So their sales for the Q3 was $33.3 billion, 5.1 of EBITDA, which is about 15% upside from where we were, or 15% overall. You can see it's quite diversified. So although US and Canada is about 6%, 40% of their revenue also comes from different places around the world. As well as that, there you can see there how it's actually the whole revenue basically is divided into different types of segments of different businesses, if you like. So as you can see, it's not just a company that just sells one single product. They have a different types of product. They have in terms of their revenue, as you can see here, from 2020 to up to now where we are, it's actually heading the right direction. It's growing. I'll give you more information on that. So it's one of those businesses where not many people really talk about, and it's not as exciting as the Nvidias, the AMDs, or whatever. But they are growing their dividends, and I'll share with you and all of that information in a second. But this is, for me, is one of the kind of foundational stocks that I like to have in my portfolio, because it's the steady eddy kind of business, grows about 5 to 10% every single year and so on. So let me give you the financials next. Okay, first we're going to look at the financials in terms of revenue side of things. So from 2013 about $17 billion to right now about $33 billion. So it has been growing nicely over the last whatever years. So from 17 to 19, 20, 23, all the way to right now $33 billion, which is quite nice. If we just have a quick look in the net income, so $1.4 billion to right now $2.7 billion. Now if we look at here, as you can see here, it has a market cap of $32.5 billion and a very, very safe dividend of 98%. The dividend is about basically 3% almost right now. And when you look at the payout ratio, only 32%. So they have room to grow that dividend moving forward. 7% growth, the latest was 7%, and the 5-year growth rate of 7%, which is quite nice. For the last 20 years, they grew this dividend about 16%. That's 7% you get basically on your increment on your money without having to do anything. And as you can see, this is actually heading the right direction. They've increased that dividend for 17 years without cutting it. Okay, 17 years increase consecutively, 17 years, and without cutting for 30 years, which is really nice. You get $6.72 for every share of this company that you own, and this is what you will get per quarter. Now it looks reasonable according to this. So right now the 5-year average is 2.78. The current dividend is about 2.93. So it's kind of reasonable right now. In terms of PE right now, it's about 12. The 5-year average about 12.6. So, and the industrials is actually 20. So in that sense, it actually also seems reasonable. Now, a few more things that we need to look at. I'm going to jump straight into this shares outstanding here. And as you can see, they are declining, which is quite nice. Total sales basically is also increasing every single year. Apart from 2020 and 2016, it actually has gone up almost every single year, which is quite nice to see. Return on equity 27% and return on invested capital of 18%, which is really nice. Operating margin is 11% right now, and free cash flow margin of 7%, which is nice. Net EBITDA, net debt to EBITDA right now 1.02 is basically what is expected for the next 12 months, but below 2.5 is basically what's expected from the equipment makers and so on. Now looking at earnings estimates in Seeking Alpha, as you can see here, 2023, so they've got one more to report. They will be up about 21%, and so right now for 2024 minus 2.37. maybe that's why the company has not done well in terms of price wise in the last couple of months. But 2025, they expected to bounce back almost 13% and then almost 14% from there onwards. In terms of revenue, also more or less the same. So like I said, these are the type of business that will grow their revenue about 4%, 5% every single year. And of course, EPS has actually done quite well in the last few years. Now looking at Yahoo Finance, okay, so they're expecting the earnings to grow about negative for basically next year, like we've already seen. But then after that, almost every single year, you'll make about 12%. Basically, will go up about 12%. Now, I'm going to compare this company to other companies. So similar sort of in the similar sector. So I'm going to select some of these companies. So this is Mercedes, company that owns Mercedes, company that owns the Toyota company, because they do also have the engines, don't they? So let's compare that with these two companies. But I'm going to do the profitability. I'm going to do total return in the last 1 year. As you can see, it's flat, and S&P 500 was about 24%. The Mercedes company is actually about 10%, and Toyota is about 41%. Now, when you look at the 3 years, it hasn't done well either. It's about 4%. The S&P is done about 27%. This one is done minus 11%, and this one is about 2%, which is not great at all. But when you compare it with the 5 years, As you can see here, the S&P 500 was 83%. This was almost 80%. This has not done well at all. And this one was about 60%, almost 70%. But when you look at the last 10 years, 100 and almost to 40%, 165 for the S&P 500. So not far off. Okay, and these two actually have not done well at all. So when you compare it with the peers in their some same sort of industry, it's actually done reasonably well for the last 5 years and 10 years. And hence why I like to hold companies for 5 years, 10 years, if not more, because that is when you see a proper return for your money. If it's, of course, you invest in good companies. If you invest in a terrible business, then of course it's not going to make any difference whether you hold it 1 year or 10 years, right? Couple of issues with this company right now, and the reason probably why it's down quite a bit. So if we go back here, I'm going to show you one of those. Okay, it was downgraded yesterday and basically to underperform at the Bank of America just recently. I think it was yesterday, and because of that, the stock went down. I think about 2% or whatever it was. Yeah, almost almost 2%. But also the other reason is the company has to now pay $1.67 billion in civil penalty. And what this means is basically the California, I think, is charging this company to pay off that much because apparently they lied about some sort of so basically they violated something to do with the software they have, so something to do with the emissions and so on. So for that reason, they were fined $1.675 billion, and they have to pay that. And also they have to now bring back some of those companies, some of those products, so vehicles recalled, to repair and replace the engine control software, basically in hundreds of thousands of RAM and so on. So basically they will have to now keep monitoring that, as well as, of course, extending the warranty. So this is one payment that they have to do. So this is not something that's going to continue. The company has already admitted to it, and they're going to pay that fine. And of course, it's a small cap company. It's not a huge company, as you've seen here. Okay, about 30 something billion dollars, $32 billion. So they're paying about $2 billion of their revenue back to sorting out this issue. And that's probably one of the reasons why the stock has not done well in the last few weeks. And when you look at this Morningstar valuation, they've already taken that into consideration. They've said it's unchanged following the $2 billion emission charge announcement. So even then, they say, nope, we're not going to worry about it. With our valuation, it stays the same. $248 per share is where they think the price should be. And as you can see right now, is $229 per share. So a little bit fairly valued at this moment in time. Right, according to Simply Wall Street, as you can see, is undervalued about almost 9%. $250 per share is where they think the price should be. Now I'm going to give you basically an average valuation for this company. So Morningstar valuation, we've seen that. Simply Wall Street, we've seen it. Seeking Alpha is saying 258. And right now, discounted cash flow model has given me $214 per share. And on average, basically average intrinsic value for the business is $242 per share right now. Current price is $229. That's about 6% upside from where we are. If you think the risk of those $2 billion is going to be huge, and you maybe want about 10% discount, then you might just want to wait for a listing until it hits 218 or even below that. If you think, okay, it's not too much risk, okay, I'm going to go with 5%, then that's absolutely fine. Right now, it will be a buy. $230 per share is where you will enter, which is basically where it is right now. Now, I genuinely like the business. I do own this stock, so just to be transparent, I will show you here. I've got 17 shares right now. I will definitely be buying in the next few weeks. I want to get to 30 shares minimum, inshallah, as soon as I can. And that is the company that I wanted to share with you guys right now. Again, it doesn't mean go away and buy it. Of course, you do your own research and find out a bit more information about the business. I've done my part, so you're just going to have to do whatever you can, inshallah. Have a wonderful day. Assalamu Alaikum.